welcome to EQT Holdings half-year results to 31 December 2023. I'm Mick O'Brien, I'm the Managing Director of the company, and I'm here with Philip Gentry, our Chief Financial Officer and Chief Operating Officer. Now, before we start, I just want to recognise Philip's contribution over the last 8 years. We announced late last year that he's stepping down and is going to try and do some other things over time. But we're delighted we've had him for this period of time, and we'll have him for a number of months yet. But this is his 17th set of results, all delivered incredibly professionally. So thank you, Philip, and I'll miss you on the roadshows in the future. Let's just move on to the agenda. I'm going to give you an overview of the results and importantly give you an update on AET. Philip's going to go through the financials in some detail, and then I'll just update you on strategy. So let me give you an overview of the results. So at a headline level, the funds under management, administration and supervision are up to $183.5 billion. You can see there that we're comparing versus the first half of 23, that's up 18%, and versus the second half of 23, so the most recent period, up 14.6%. And we're doing that throughout the presentation because really a comparison to the most previous half is a like-for-like basis. When you're comparing to the first half of 23, we've got AET in these numbers for 6 months on this period, but it's only in for 1 month on that first half of 23. So hence the double comparisons. Revenue is up 37% to 84 million. Importantly, up 8.1% on the prior half. So that's, if you like, a like-for-like, and that tells you, the really strong revenue growth and primarily organic revenue growth rather than investment market growth. Net profit after tax was 12.6 million, so up 65% on the prior corresponding period and 12.9% on the second half of 23. On an underlying basis, and Philip will go through these details in a little later on, it's up 24.8% on prior corresponding period and down 1.8% on the previous half. Now that's reflecting revenue growth, but also expense growth of similar levels. So, and we'll talk in more detail about that shortly. On the dividends, the board chose to increase the dividend 1 cent, the last final dividend, and that's 2 cents up on the prior corresponding period. And the balance sheet remains in very strong position. So let me just look at the funds under management, administration and supervision. This is the key driver of revenue in the business. You can see that the progression is really consistent growth. It's really been quite an extraordinary half with almost $24 billion of assets being added under our supervision, the bulk of that in superannuation, which I'll show in a sec. And note there that there's $5.5 billion from our UK Ireland operations that will, we hope in the next number of months, disappear off those slides. So, but in any event, just making the point, $24 billion of funds growth and continues this consistent theme. If I just look at each of the business lines, I'll start with corporate and superannuation trustee services, the corporate side of it. And you can see it's gone from 99 billion up to 106 billion. So $7 billion growth. It's coming from a range of funds. I should say a good amount of that growth is coming from what I describe as a trustee directed type of portfolio. So it's a lower margin type of fund. But I'm really comfortable with how this business is growing in terms of number of new funds that have come on board in the last period, and what we have sitting in the pipeline, which I think is about 40 new schemes being set up. I'll move over to the right-hand side and look at superannuation. You can see it's now almost reached 60 billion, so $15 billion growth in the half. That's a result of 3 new funds coming on board, so the Future Group at the start of the period, and then at the end of the period, Guild Super and Clearview Superannuation. And so really there's no revenue in the numbers for those last 2 new appointments. So there were 3 of the big changes. We also had a transfer of 3 billion into one of our existing clients at the start of the period. And also just generally the portfolio is growing on a net funds flow basis and quite strong. So that now puts our superannuation business in the top 10 in terms of funds under supervision. Also the top 10 in terms of number of members. I think we're overseeing about 800,000 members in those 15 funds. Move down to the bottom left block and look at Trustee Wealth Services. $1 billion of growth up to 17.3 billion. That is coming from all lines of business in Trustee Wealth Services. So health and personal injury, our native title trusts, it's coming in the philanthropy side as well. So, and also, of course, asset management, particularly on the back of some of the shift of the AET funds. And then the right-hand bottom block, I'm just showing there the asset management performance and just showing alpha generation there. And if you look at the one-year numbers, we've got positive numbers across almost every asset class. Really pleasingly, the two new asset classes, 8Bay's Global Equities and the Spectrum Strategic Income Strategy, really strong positive alpha in the last year. And if you look at over the 3 and 5 years on Australian equities, which is the main asset class, really sound alpha generation from the team, which is so important for our clients. I should just say we are going through a transformative period and there is increased regulatory scrutiny. That's a two-edged sword for equity trustees. One, it makes our services all the more valuable, but of course it's also increased workload for us. But the reality is the independent model for trusteeship is being sought more and more. The transformation we're going through is really twofold. Firstly, the AET acquisition, which happened in November of 22, is going to take us close on 2 years to be fully integrated. And part of the reason for that is because we are exiting some lines of business and we are building a new platform at the same time to take that business on board, as well as our own Trustee Wealth Services business. We're sort of 2 years into the 3 years of this technology transformation, and there's other elements to that as well. We announced 6 months ago that we're combining our superannuation and corporate trustee services business units. That's because they are very aligned operating models. We believe we can capitalise more on the strengths of each business by having them together under the leadership of Andrew Godfrey. And we're starting to achieve that now. And I think that this will set these businesses up for growth that can be leveraged into earnings. So, really comfortable with how those two businesses units are coming together. We're well advanced on the exit of the business in the UK and Ireland. In Ireland, we are selling that business and waiting on the Central Bank of Ireland's approval to that. In the UK, we are transferring clients to other providers, and we may also sell that entity as well. We expect to be out of that business by June. When we acquired AET, we picked up a platform administration business. That's not the sort of business that we'd like to be in. So we're well progressed in the exiting out of that by transferring clients. We're also, AET was providing administration services to small APRA funds. And again, that's not a line of business that we'd like to be in. So we're transferring that administration across to Super Concepts in Adelaide. And that's well progressed. And we hope to have that done by the end of this financial year. We continue fulfilling our purpose of trust and caring for people and enriching the broader community. Now, I just do want to focus a little on the technology because there's a big development going on and we're sort of, as I said, about 2 years into a 3-year build. On the Trustee Wealth Services side, we deployed the iFi system, that's leading US technology for active philanthropy. I should say we now have that business. We've moved AET onto it. We've also moved the JB Weir foundations onto it. So more than 400 accounts that we have. So active philanthropists, $350 million. This is a business that we really want to grow strongly, and we're putting a lot of resource into it, and it'll be a big focus over the course of the next half. The biggest development on this page is the development of the Trust Key platform for Trustee Wealth Services traditional trust business. Linked together with Hub24 as a custodian of those assets, and also Hub24 as a provider of our non-traditional trusts in Trustee Wealth Services. That development's going well. We've already had one major account on the platform from about 12 months ago in our cash fund. We're about to put our continuing trusts onto the platform on the 4th of March. So all the clients, about 1,500, half of them coming from AET, from the TACT platform within Insignia, and the other half coming from the Garradin platform within our environment, going onto that. And once we've done that, we'll then progress through the other lines of Trustee Wealth Services business and hope to have this project finished by November of this year and be out of the Insignia platforms by that stage. Salesforce, a major client management platform that we're using, is being implemented for estate planning and for estate management in this business. On corporate trustee and superannuation business, we have been deploying Salesforce as the client management platform. We're also customising our superannuation oversight platform, so it's a reporting and member outcome assessment platform, which is important that we can leverage our ability to do 140 member outcome assessments across our 15 or so funds. And Ziegler we use for overseeing outsourced service providers. So a big part of this business is that we outsource custodianship, administration, registry, prime broking, and the like to a range of different parties. At the moment, I think we're at 50 service providers, so we need to be super efficient at that oversight, and Ziegler is the platform we use. And then from the group perspective, we've implemented Workday in the finance team. Philip and the team have done that, and we've closed the last 2 months under Workday, so that has gone really well for us. We're about to implement Workday also for human resources, and we've started that project, and that will be completed through the course of this year. So there have been major developments, but it really makes us fit for purpose in terms of the size and scale and complexity of this business to have those types of platforms. We introduced a new AML system, Satori, and that's going well. And we've continued upgrading our cyber security, and we'll continue to do that. We feel in a comfortable position with a very, if you like, diversified digital base across the whole business, which helps us in many respects. If I just move on, we often talk about delivering to all stakeholders. Obviously, we're talking here to shareholders, and we'll come to the other shareholder results. But for clients, we survey our clients each year. We're really positive results there on Net Promoter Score and Net Loyalty Score. We're about to go out to clients again right now, and looking forward to seeing how they are experiencing our services over the course of last year. On the employee front, we sit at 75% on engagement and enablement. And we are about to survey our employees again, and looking forward to seeing those results. But that 75 level is really at the high performing level of the market data, and really goes to the testament of the culture of the organisation. And on the community front, this business can impact the community probably more than most. We've distributed last year a record amount of $122 million to charities and other for-purpose organisations. We're slowly building up our volunteering days after COVID sort of, really made that program difficult to do. We're really keen to do that. And of course, our trust management services to Indigenous communities is now a much more significant scale across Indigenous communities, with more than 20 communities and $500 million of those communities, their wealth that we are protecting and growing and distributing. So very proud of what we do there. For shareholders, so if I just look there at earnings per share, you can see there on an underlying basis, it's up to 67.48 cents. On a statutory basis, 54 cents. So that's up 7.1% on a statutory basis. The underlying EPS on PCP is up 15.1%. It's down 2.8% on the most recent half. And Phil will go through more of that detail. But it's a strong underlying EPS result. The dividend progression, you can see there, very consistent, growing dividends. The board has chosen again to increase the dividend to 51 cents, and well within that range of the underlying EPS. With AET, there's really two major initiatives to complete the integration. First is the exit of all the platform business. We're well progressed on that. That includes the outsourcing of administration of small APRA funds to Super Concepts. We expect to have that all completed by June. We're about halfway through the client base exiting at this point in time. And then the bottom part is building of the new TrustKey NavOne platform to take all of our traditional trust business as well as our non-traditional trust business. So that's the advice and health and personal injury business. And we're well advanced on that. 4th of March is a key date to shift across a big part of the client base. And we'll progressively roll out another 4 phases of that migration between now and the end of this year, and expect to fully exit from the Insignia systems by November of 24. And by this stage, all expense synergies should be able to be realised in the business. Move on to the next page. It just walks through a range of different things that we've been doing on the AET front. Much the same as what we showed 6 months ago, so I'm not going to run down through this slide, but I do just want to make a couple of points. We've been delighted with the people that have come on board. We've been able to retain all of the key talent across the country. We have had no material client losses in this business, and new business generation has continued afoot. So really comfortable with how the AET business is integrating to our group. Now, this slide just walks through the synergies and starts on the left-hand side there with net cost synergies. You can see there 2.9 million is what we are forecasting at this point. That's a little lower than what we anticipated right at the start of this integration. On the revenue side, we're now projecting ultimate revenue synergies of 5.8 million per annum. So that's a couple, 2.5 million higher than what we had originally anticipated when we acquired the business. So in all, aggregate synergies of 8.7 million, so a couple of $1 million higher than originally anticipated. Implementation costs 22 million. We're on track to get this complete within that envelope, and that'll be expended by basically by the end of this calendar year. Originally, we did not expect to get any capital release from the AET business, but we now think that we can get a $10 million capital release, and we have a program of work aimed at achieving that release. And again, we're targeting that for the end of the calendar year. So in summary, it's been a very big half in terms of growing the size of the business and our footprint to $183 billion. Statutory EPS is well up on the PCP, and in the last 6 months prior reflects some of the investment that we've been making in AET and the technology transformation. The AET integration is proceeding well, confirming that we are very confident about the synergies. The technology build is a big build for us, but it will create a great foundation for this business. We continue deepening our community impact and look forward to continue delivering for all of our stakeholders. So I'll stop there and hand over to Philip.
Many thanks, mate. Let me now just turn to the financials in a bit more detail. I'll take you through the income statement. We'll look at the key businesses and their drivers of performance, and then touch on the balance sheet, cash flow, and liquidity, so you've got a reasonably full picture. Firstly, just looking at the overall income statement here, perhaps the first point to make is that we have classified the UK and the Irish businesses as discontinued. And in this particular slide here, the top 5 lines are all effectively from the continuing businesses. You'll see the split in the detail in the financial statements around how we've dealt with the discontinued businesses in more detail. But from a top line standpoint, you can see the revenue, pretty strong growth, half on half. That's one of the stronger half on growths we've managed to achieve. And again, I'll break that down in a bit more detail for you shortly. Expense growth reflects the one-off integration costs, the AET contribution, and higher levels of resourcing and technology investment. Impact up 12.9% on the prior half and 65% on the PCP, reflecting particularly the addition of AET. Underlying impact just down slightly on the second half 23, reflecting that higher investment in people costs in particular. And historically, very low vacancies, and again, I'll talk a bit more about that shortly. Statutory EPS 47.5 cents, well up on the prior half of the PCP, and underlying EPS of 67.5 cents. 15% up on the PCP and slightly down in the prior period. Now let's look at the revenue breakdown in a bit more detail. Here you can see the bridge. If you just move from left to right there, you can see the contribution of AET, the equity market impact on FUMAS, the large mandate loss in CTS, which we previously flagged, 1.7 million of AET synergies starting to come through, and that will grow significantly over the next period. And quite strong organic growth with a certain amount of repricing, particularly with our SAF products, that have contributed to a pretty strong revenue number for the first half for continuing businesses. Now let's turn to the expense analysis. Again, a bridge here. You can see the breakdown of non-recurring AET uplift and OPEX expenses. I won't go through each line item there, but if we look at the underlying increase in expenses, excluding the non-recurring in the AET, it's up about 12%, primarily driven by the increase in salaries and related costs, particularly the significant reduction in vacancy levels to really historic lows. We're talking sort of low single digits compared to, low double digits more typically in years gone by. Obviously, the inflationary pressures have played a role as well, and typically replacement staff have been brought on at higher salary levels than previously incumbents occupied. Let's now turn to the BUs in a bit more detail. So just before we do that, the key financial measures, just showing some sort of trend analysis here. You can see that on the revenues, very strong, half on half. EBITDA, they've generally got positive traction on all of these measures. Dividends particularly consistent over the halves. Then now to the business units and looking first at TWS. You can see here a simple revenue bridge for the TWS business, the AET contribution, a relatively modest impact from the equity markets, the AET synergies coming through, and good organic growth for TWS. And on the right-hand side, you can see the increase in FUMAS compared with the PCP. Asset management in particular growing quite strongly from nearly 5 billion to just over 6 billion. And the largest chunk of that growth is represented by the take on of asset management of a significant portfolio of health and personal injury clients. Let's look at the sub-BUs in TWS in a bit more detail now. Here you can see that AET is certainly assisting momentum across the various component pieces of TWS. Estate management on the face of it looks down. But remember, the value of these estates is quite volatile and it will bounce around from time to time. We're quite satisfied with our ability to win business in this space, and it's going well. Perhaps worth calling out the active philanthropy increase. Mick touched on the iFi platform that's been launched, and that's certainly paying dividends, and also in the community and native title trust space, where particularly good momentum following the acquisition of AET. Now turning to CSTS, the combination of our corporate trustee and our superannuation businesses. Again, the revenue bridge showing the AET SAFs, the contribution they're making, a more material impact from equity markets, the large mandate loss I've touched on before, and again, pretty strong revenue growth, and you also reflected in the funds under supervision, which you can see on the right. And Mick also touched, you can see on that bottom bullet point, we had end of period appointments to both Guild Super and Clearview Super, which really haven't contributed during the half, but will be very helpful in the half to come. Now turning to superannuation, a bit more detail. Here you can see the pretty significant increase in funds under supervision. The key drivers on the bottom left-hand side there, Future Super Growth and Circle Superannuation Fund transferred to Centric, the SAFs and Guild and Clearview, which came in during the December month. All leading to a 30% increase in members to around 800,000 and as Mick said, a top 10 superannuation business in Australia now. Turning to the CSTS corporate piece. So this is our traditional corporate trustee services business. Again, good underlying growth, equity market impact contributing as well. Funds under supervision up. Quite a few new clients here, and some of the key ones we've called out. And momentum continues at a higher than usual rate. If I look back over the years, currently establishing over 40 funds, with 30 expected to be launched before the 30th of June. So continuing high levels of activity here. The increase in global asset managers continues to be evident, and a pretty strong pipeline across all of the sub-businesses within this business unit. Quick breakdown of some of the funds that are being opened and closed. You can see this is generally net positive. New funds, some 31 over the period, some 19 closed, and a little closer on the fund manager movements. Then from a fund manager location standpoint, you can see Australia still dominates, but a pretty substantial global footprint as well. Looking at the custody debt and securitization business, look, growth has eased a little, particularly in the debt capital markets, reflecting the higher interest rates. But in recent months, we've seen momentum starting to rebuild as sentiment improves, and we're expecting a solid performance in the second half in this particular business unit. And finally, turning to UK Ireland, the exit is well underway. The Irish business has been sold subject to certain approvals, particularly the Central Bank of Ireland approval. We're still waiting on that, but we're hopeful that that will occur shortly. The UK business remains in a sale process, although managed wind downs also being considered. We do expect to be substantively out of these businesses by 30 June 24. It may be there's some residual activity still to close out, but I don't expect them to be significant. On the technology front, just providing a bit of an update on the outlook for the spend there in particular. Mix highlight, I think, most of the key projects that are underway, the largest being the Trustee implementation for the TWS business. So the OPEX and CAPEX slightly changed from what you will have seen at the full year, but not dramatically. The projects are all largely on track, and we're very pleased with how they're going. Now turning to the balance sheet, continues to be very strong. Debt equity 11.5% is quite conservative. I'll talk about the cash and liquidity position shortly. We've got substantial headroom in our covenants and plenty of flexibility to take advantage of future opportunities. On the cash flow front, operating cash flow improved from the previous half. You can see the cash flow generation is looking pretty healthy. That's been utilised to pay dividends and tax in the main. There has been some borrowings, particularly to help fund the integration costs that we've been undertaking. And I do expect the working capital position to improve further in the second half. From a liquidity standpoint, also very strong. On the left-hand side here, you can see our liquid assets held, which includes cash plus a percentage of accruals and debtors. Regulatory capital of 91.7 million, which combines the traditional regulatory capital as well as the RFR-related capital, leaving net available liquidity of 49 million and committed undrawn facilities of 34, so circa 83 million of financial flexibility should it be required. In summary, very strong organic revenue growth, higher expenses due to the one-off integration transformation costs and higher people costs to support growth and transformation. Statutory impact impacted by these one-offs, but the underlying performance is pretty solid. AET is going well. Cash generation is improving. We've got a sound capital position. Back to you to take us through the strategy.
Thank you, Philip. Yeah, so let me just give you an update on the strategy. So the reality is our strategy hasn't changed. It's holding us in good stead. Our purpose to help people take care of the future really is resonating with clients, but also resonating with employees. So we've been very successful at securing the talent that we've needed to secure, all underpinned by our three core values, which is so important to trusteeship. If I just flesh out the strategy a little more, but again, without going through the detail, because this slide hasn't changed, we're aiming for consistent growth in shareholder value and returns. So, there's not a company that's going to be blowing out the water one period and not the other, right? Consistent growth in shareholder value and returns. Market leadership in our specialty areas, so that's quite important. And the AET acquisition was really critical in achieving that for us. And reputation is everything to this organisation. It's a stable, 140-year enduring organisation that can be trusted. If I just look at our market position and staying on trustee wealth services, so one of the key objectives of acquiring the AET business was to build our position in the health and personal injury sector, where we're now clearly the leader. We were already the leader in philanthropy, we're the leader in estate management in Australia, a leader in estate planning amongst trustee companies, and also a leading business on continuing trust. So AET has given us that position across all of those sectors. Dropping down to the right-hand box, expanded geographic capability. We obviously had a strong position here in Melbourne, AET was the clear leader, the only player really in South Australia, and the clear leader in Western Australia as well. And we've strengthened our positions in the other two states in New South Wales and Queensland. On the corporate trustee services side, responsible entity services to funds managers and asset owners, we've continued to build a really strong position there and clearly leading that market. We're trying to build our businesses in custody and real assets, the DCM and securitisation markets, and in superannuation, the leading independent provider of trustee services there. So it's a really strong market position across the board, and our asset management capability is absolutely designed to be fit for purpose for the needs of our trustee clients. Our initiatives in FY24, just starting on trustee wealth services. So firstly, continuing and finishing what we're doing on AET integration and the platform divestment, capitalising on what I just described there, the market leading position we've got. So capitalising on business development across all the states and all the sectors. We'll be putting a lot more effort into the public launch of our leading philanthropy platform, iFi. We've got the team in place, we've got the technology in place. We would have done this earlier, but we had to shift resource to bring on the JBWere Foundation, also the NAB Foundation onto this platform. Finish off the 2-year build on the technology. We want to continue developing our responsible investing capability. There's significant demand for that, and it's important to do that, and capitalising on the high-rated top performing investment funds. For superannuation and the corporate trustee business, it's quite similar. In superannuation, it's really about focusing in on the retail segment of the market where we get new startups coming, as well as funds that are transferring their trusteeship. We want to build operational excellence now. We've got the scale in that business. On the corporate side, again, we want to streamline and digitise a lot of our workflows. This is a portfolio now of over 100 billion, something like 400 schemes and 130 clients. So we need to keep building our the efficiency of our operations, and we want to accelerate the growth in those new markets that I mentioned before. And I should also say just continue building our capability in the listed scheme space. So we, I think, have now about a dozen schemes that are listed, another 5 in the pipeline. So the portfolio is up at 3 billion, and we see that as a material growth driver over the next number of years. I can't give this presentation without talking about risk, regulatory management and governance. It's fundamental to our business. We maintain very close relationships with the key regulators. We seek to be a model regulated entity, and I think we are achieving that. Risk culture is fundamental. Our last survey just in the last couple of months on risk culture had an 84% positive response rate around the understanding of risk by our employees. So that's a really high rate. And I'm pleased to say that AET is at the same level, the employees in AET. So it's been an extensive program of work folding AET into our governance processes, and that's now all complete and gone very smoothly. We are handling the regulatory change, some of the key things, design and distribution obligations. We worked with the FSC. I think we have hundreds of target market determinations in the market, and we're well set to be updating those. Extended our member outcome assessments as required by APRA. They're in a good position on that front. We have something like 70 schemes that have some type of ESG overlay or orientation to them, so we're very aware of the issues of greenwashing and ensuring that our disclosure is absolutely accurate and with fidelity in relation to ESG orientation. And finally, we continue putting platforms in place to handle our governance. So CAMS is our risk platform. We've got a purpose-built member outcome assessment platform. Xydler, as I mentioned before, for service provider oversight. ArcPro, putting out something is our platform for PDS disclosure production. I don't know, we must have like 1,000 PDSs and information memorandums and accompanying reference documents out on market at any point in time. And Satori for AML monitoring. So in summary, I think this strategy is on track. It's delivering great organic growth. The business is going through a major transformation at the moment. The revenue and funds continue to rise. The net profit reflects the investment that we've been putting in the last year or two. We're delighted with the AET acquisition and the market leadership position that gives us, and confident about the synergies coming forward. Technology development's going according to plan, and it will improve client experience for our clients. We want to continue building our newer, smaller businesses. As Philip said, the balance sheet's in very good position. It gives us flexibility for growth, and we see that we've got positive momentum moving into FY24 and beyond. So, and I will also just mention one other thing that's just in finishing. We will run a shareholder strategic briefing in April, and that'll be confirmed to the market very shortly. And the point of that will be just to do a deeper dive into some of these businesses, which can be a little complex to people not in the trustee space, and also to introduce more of the broader leadership team to the market. So we look forward to doing that. So I think that brings us to questions. And we had a number of questions alluded to us earlier, so I'll start with those in fairness and then move to the ones that have been saying come in. So the first one is, when will we finally be out of the UK and Ireland? How much more is there to cost in doing that?
Sure. Thanks. We're happy to talk to that. As I mentioned, we should be substantively out by 30 June. There will be some additional cost. Particular in relation to the Irish business, we're likely to write down the value of the minimum regulatory capital in that business, because that will go to the purchaser in due course, which will be about 1.1 million Australian. In relation to the UK, we're still to finalise the exact mechanism of exit there, but there'll probably be a smaller sum associated with the exit, mainly advisory and legal fees, potentially of sort of the order of $500,000 or thereabouts. Might be some break costs with a few things as well, but not too significant.
Thanks, Phil. The next question was, financial advisors are increasingly becoming asset managers by SMAs and similar. Is this a threat or an opportunity to EQT? Look, we're not overly concerned by that. There is a trend of that happening, but still the mainstream large-scale advisory groups are still using platforms underneath that, managed investment schemes. So we can provide services to SMAs, and we do that to some extent. I also point out that if you look at our CTS business, it's about 3/4 institutional flow and fund, and about 1/4 retail advisory flow and fund. So not a major issue for us. The next question is, would the ACCC allow you to buy perpetual trustees? Well, I'm not going to speculate on that. We're focused on growing this business and particularly following our acquisition of AET, following our strategy. So that's what we're doing. The next question, there's a question a little complicated about insurance and deceased estates, and I'm going to take that one offline with the gentleman who raised that. So it'll take a bit of time. The next question is, what is the annualised revenue run rate benefit on recent CTS and superannuation wins? I might hand that one to you.
Sure. I think perhaps the best way to answer this question is to confirm that the run rate is in the same sort of ballpark as what we've had in the last 6 months. So the relatively higher than perhaps historic level of activity in both CTS and the super business is likely to continue at those rates without being specific around quantifying it. It's looking pretty healthy.
Thank you, Philip. The next one I think is also for you, Philip. Can you tell us what the non-cash amortisation was for the first half?
Yeah, for the first half, the depreciation amortisation number was about 3.6 million. And about half of that, or just a little less than half, is associated with the management rights amortisation from AET.
Thank you. We'll keep running through these. Can you talk about the revenue impact from the 40 funds being established and the run rate benefit from those established over the first half of 24? I think the best way to think about that is when funds start, there's not a lot of fun in them unless they're purpose built to take in a large mandate at the start. So typically you could think about it as $45,000 to $50,000 as an annual fee on those funds. So you probably do the maths on that. Next question, any further superannuation wins in the pipeline as alluded to at the AGM? Well, I guess what we alluded to at the AGM was there are some wins in the pipeline. They have come through. So the Guild Superannuation Fund and the Clearview Superannuation Fund. And so there's still a solid pipeline there, but I don't think it's as prospective just right at this point. Next one, is there any incremental cost to the revenue synergies being generated from AET? I'll quickly take that one. The answer to that is no. There isn't any cost to those revenue synergies. The next one, corporate, was the number of funds closed and the managers exiting for the half what you were expecting? Reason for fund manager exits? Good question. Look, the portfolio is large now, as I said, with 400 schemes. So there's often schemes that just don't become successful for funds flow purpose. You know, the distribution isn't successful or the performance isn't, or whatever the case may be. So we're always going to have a little bit of that churn in the portfolio. I think, is it any different in this period? No, not really. I mean, we commented last period that there was a lot of outflow in 4 funds, something of the order of 9 billion, which was pretty much a one-off and indicated portfolio doesn't have any concentrated exposure that would produce that type of result again. I think that's where we are. The reason for fund manager exits, we very rarely lose a fund manager to an alternative provider, but it can happen from time to time. Generally, it's because the fund manager may be closing down or being bought out by another player, and that might be another reason. But there's nothing particularly to comment there. Next question, is the first half cost base indicative of the level going forward into the second half and beyond? Are there any one-off costs that won't appear in this half? And do you?
Sure. So perhaps just dealing with the second part of the question first. There will certainly be some one-off costs that continue in the second half of 24 as expected. There'll be, the integration's obviously not complete, so there'll be some ongoing costs associated with that. The technology transformation, as Mick alluded to, the biggest part of that is in relation to Trustee, and that it's not scheduled to finish till November. So obviously there'll be some costs associated with that as well. The UKI, we should be largely out of that by June, so I'm not really expecting any material costs in the half beyond that in relation to that. And then coming back to the first part of your question, yes, the first half cost base is probably somewhat indicative, given that we have pretty much filled almost all of our vacancies. I'm not really expecting to increase in terms of headcount materially in the second half, and so that delta that was perhaps more evident in the first half shouldn't be quite as significant in the second.
Thank you, Philip. I think the last question will be also for you. Can you remind us of the expected benefit of the transformation program, and is there any cost to carry through into FY25?
Yes, as I mentioned before, there will be some costs going into FY25, particularly the first half as we complete the Trustee in particular. Also, the Workday implementation is not expected to complete until around September. So there'll be a few months of spend in the first half 25. Second half 25 should be pretty clean. In terms of benefits, there's quite a number of them, but essentially we're taking equity trustees to become a much more contemporary trustee company. We're modernising our platforms. We'll have customer portals to allow self-service. They'll allow scalability. We're automating processes and platforms and workflows, which will allow scalability and an ability to win clients that perhaps we've just not been able to historically. So we're expecting pretty significant benefits from this program of activity. And perhaps it's also worth commenting that staff are very excited about what we're going to be able to offer our clients, and indeed they've been asking for it for some time. Mick, I don't know if you might want to add any comments in relation to that.
I think that's an excellent summary. Yeah, thank you, Philip. Yeah. You've answered your last question very well. Thank you. So we've got no more questions. I think we're on time, and I just want to thank everyone for their attendance this morning, and thank you for your support of the company. I feel we're in an excellent position. Going forward, we've had a very good half where we've got a lot of work to do coming up. but we're well positioned to do it. So again, thank you so much for your support. Look forward to seeing many of you as we get out on a roadshow over coming days. And I just want to thank again Philip for his contribution over 8 years to the company. And also sitting beside me for 17. Well, I've done 16, so he's done 17. And that first one wasn't so good from memory. So a bit better since. So I've really appreciated it, and I know that our shareholders really value your ability to communicate these results in a way that's understandable. So thank you. Yeah. Okay, thank you, everyone.